Welcome to StokTok's deep dive into Uber technologies. Uber is the world's largest ride-hailing and food delivery platform, connecting consumers, drivers, and merchants across more than 70 countries. At the time of recording, the stock is trading at 77.12, sitting roughly 12% above its 52-week low of 68.46, but meaningfully below its 52-week high of 101.99. The 50-day moving average stands at 73.41, while the 200-day moving average is at 86.15, meaning the price is above near-term support but still below its longer-term trend line. The RSI, or Relative Strength Index, which measures momentum on a scale of 0 to 100, reads 60.5, firmly in neutral territory, suggesting the stock is neither overbought nor oversold. The structural setup is one of recovery, not euphoria. Let's work through the fundamentals, scene by scene, starting with a quick business overview. Uber Technologies operates a two-sided marketplace, matching riders with drivers and diners with restaurants through its mobility and delivery segments, with freight logistics rounding out the portfolio. The company's competitive moat is built on network density. More drivers attract more riders, which attracts more drivers. The StokTok score for Uber Technologies comes in at 69 out of 100, a buy signal. Growth leads the scorecard at 19 out of 20. Financial health follows at 15 out of 20. Profitability earns 13 out of 20. Valuation scores 14 out of 20. Smart money is the weakest link at 8 out of 20, a nuance we will unpack shortly. Now, valuation. The question every investor has to answer: are you paying the right price? Uber Technologies carries a trailing price-to-earnings ratio, that is, current price divided by the last 12 months of earnings per share, of 16.37 times. For a platform of this scale and growth trajectory, that reads as surprisingly modest. The forward price-to-earnings, based on next year's earnings estimates, steps up to 22.75 times, which reflects the street's expectation for earnings growth ahead. The EV to EBITDA ratio, enterprise value divided by earnings before interest, taxes, depreciation, and amortization, a cleaner measure of operating value, stands at 23.08 times. That is elevated by traditional standards, but in line with what the market typically awards high-growth platform businesses. In our view, the economic moat here is structural. Uber Technologies benefits from powerful network effects, geographic density advantages, and meaningful brand recognition, all of which create real switching costs for both riders and drivers. The GuruFocus Value, an independent estimate of intrinsic worth, sits at 93.23 at the time of recording, against a market price of 77.12. That implies a margin of safety, the discount to fair value, of approximately 17%, which we find constructive. Wall Street analysts at the time of recording have a consensus mean price target of 103, drawn from 52 analysts, with a high target of 150. The next earnings report is due on May 6, 2026, with the street expecting earnings per share of approximately 0.69, a near-term catalyst worth monitoring. Market sentiment around Uber Technologies, as of the creation of this video, leans cautiously bullish, supported by dip buying signals, technical momentum above the 50-day moving average, and growing robotaxi partnerships that reinforce the autonomous vehicle strategy. Based on what we see, the valuation is not cheap in absolute terms, but relative to growth, the data suggests a reasonable entry point. Moving to financial strength, how solid is the foundation? The Piotroski F-score, a 9-point checklist assessing profitability signals, leverage trends, and operating efficiency, comes in at 7 out of 9 for Uber Technologies. Scores of 7 or above are generally associated with financially improving businesses, and in our view, this reading reflects a company that has materially strengthened its fundamentals in recent periods. The Altman Z score, a composite model used to estimate the probability of financial distress, registers 3.77, comfortably in what the model classifies as the safe zone, above the threshold of 3. On the debt side, the cash-to-debt ratio is 0.63, meaning the company holds roughly 63 cents of cash for every dollar of debt. That is not a fortress balance sheet, but it is manageable. Interest coverage of 12.65 times, meaning operating earnings, are nearly 13 times larger than interest expenses, signals that servicing the debt is not a strain. The current ratio, which measures short-term assets against short-term liabilities, stands at 1.14, just above the 1-to-1 threshold that defines adequate near-term liquidity. Debt to equity is 0.45, a moderate leverage level that does not concern us at current earnings power. The overall read on financial health is solid, not exceptional, but Uber Technologies is clearly not a balance sheet risk story. Next up, profitability. Is this business actually making money efficiently? We lead with return on invested capital at 11.03%. Return on invested capital measures how much after-tax operating profit a company generates for every dollar of capital deployed. 11% is a meaningful threshold. It suggests the business is creating value above its cost of capital, which is the baseline requirement for any quality compounder. The gross margin, revenue minus direct costs, divided by revenue, is 39.75%. For a marketplace business that does not own the vehicles or kitchens, this reflects healthy economics at the top of the income statement. The operating margin, which accounts for overhead and platform costs, is 10.70%, a real and positive number that speaks to the maturation of the business model after years of heavy investment. Net margin stands at 19.33%, which is notably above the operating margin, a dynamic worth watching closely, as it can reflect one-time items or investment gains rather than pure operating performance. Free cash flow margin is 18.77%, meaning the company converts nearly 19 cents of every revenue dollar into free cash. And in our view, free cash flow is ultimately the most honest measure of economic health. Return on equity of 41.44% is eye-catching, though partly a function of the capital structure rather than pure operational efficiency. Taken together, the profitability profile signals a business that has crossed into genuine earnings generation. Onto growth. Is this business expanding, and at what rate? The revenue growth figures here are some of the most compelling data points in the entire analysis. Over the trailing 3 years, Uber Technologies has compounded revenue at 17.70% annually. Extend that window to 5 years, and the compounded annual growth rate rises to 30.20%. That 5-year figure reflects a business that was in heavy expansion mode and executed at scale. 30% compound annual growth for 5 consecutive years is a benchmark very few companies of this size achieve. The deceleration from 30% to approximately 18% over the more recent 3-year window is worth acknowledging. As the revenue base grows larger, sustaining high percentage growth becomes mathematically harder. That is not a red flag. It is a natural function of scale, but it is a dynamic we would want to see management address through new verticals, notably autonomous vehicle integration and advertising revenue on the platform. Book value per share, total equity divided by shares outstanding, a measure of net worth accumulation, has grown at 52.90% over the trailing 3 years. That is an extraordinary rate of book value creation and reflects the pivot from loss generation to genuine equity building. Uber Technologies pays no dividend, which is consistent with a growth-oriented capital allocation strategy. The company is reinvesting capital rather than returning it. In our view, the growth dimension is the clearest bull case for this name. Now let's talk smart money. What institutional capital is actually doing with this name? 28 top-tier investment managers, tracked by Dataroma, currently hold positions in Uber Technologies. That is a notable level of concentration among high-conviction, long-only funds. Let's walk through the key names. Bill Ackman of Pershing Square Capital Management holds Uber Technologies as 15.90% of his portfolio, making it a significant conviction position, though he has marginally trimmed, reducing his stake by 0.21% in the most recent period. Thomas Russo of Gardner Russo & Quinn has been actively adding, increasing his position by 9.22%, bringing the stock to 4.54% of his portfolio. John Armitage of Edgerton Capital has initiated a new buy. Those are constructive signals from sophisticated, long-horizon investors. On the other side, David Tepper of Appaloosa Management has reduced his position by 23.14%, a meaningful trim that warrants attention, as Tepper is known for macro-driven positioning. The broader institutional picture is more cautious. Only 15.6% of 13F filers, institutions required to disclose their holdings, are net buyers, which means the majority are either holding or selling. That is the data behind the smart money score of 8 out of 20. Insider ownership stands at 1.72%, low by the standards of founder-led businesses. And recent insider transactions show 1 buy against 2 sells over the trailing 3 months. The smart money signal here is genuinely mixed, and in our opinion, warrants careful monitoring. And finally, the verdict. Let's bring it all together. On valuation, the trailing earnings multiple is modest for the growth on offer. The GuruFocus Value implies a 17% discount to fair value at the time of recording, and Wall Street's consensus target sits meaningfully above the current price. In our view, the setup looks interesting relative to intrinsic value. On financial strength, a Piotroski score of 7 and an Altman Z score firmly in the safe zone tell us the foundation is solid. This is not a fragile balance sheet. On profitability, the business has crossed a critical threshold: double-digit operating margins, nearly 19% free cash flow conversion, and a return on invested capital above the cost of capital all suggest a genuine earnings engine, not an accounting construct. On growth, 30% compounded revenue growth over 5 years, decelerating to a still healthy 18% more recently, combined with extraordinary book value creation, makes the growth dimension the most compelling part of the thesis. On smart money, the picture is nuanced. High conviction holders like Ackman and Russo are present, but low insider ownership, net institutional selling, and Tepper's significant trim introduce real uncertainty that this warrants caution about, in our opinion. The overall thesis, based on what we see, is that Uber Technologies is a high-quality, maturing platform business trading at a reasonable discount to estimated fair value, with autonomous vehicle integration as a genuine long-term optionality layer. Everything in this video is our interpretation of publicly available data, not financial advice. Please consult a licensed financial advisor before making any investment decisions. That's the deep dive on Uber Technologies. Like and subscribe so we can keep providing you with no-nonsense, data-driven analysis of stocks. We will keep updating our videos as soon as new data that affects the stock becomes available.